Welcome back to Smart Dollar Mindset, the channel that's all about helping you make smarter financial decisions, master your money, and achieve long-term financial freedom. If you're new here, hit that subscribe button because every week we bring you practical, actionable content that can change your financial life. Today, we're answering an important question that impacts millions of people. How do credit cards affect your credit score? If you have a credit card, or are thinking about getting one, understanding this is critical. Your credit score influences everything from the interest rate on your mortgage to whether you get approved for a car loan or even a rental application. The way you use your credit card can either boost your score and open doors to financial opportunities or drag your score down and make life more expensive. By the end of this video, you'll know the 5 factors that determine your credit score, how credit cards play a role in each factor, real-life examples of how small decisions can impact your score, common mistakes that hurt your credit, proven strategies to use credit cards as a tool to build, not break, your credit. Let's dive in because this could be the most important video you watch all year if you want to take control of your financial future. Why your credit score matters. Your credit score is a 3-digit number, usually ranging from 300 to 850, that represents your creditworthiness, or how likely you are to repay borrowed money. Lenders, landlords, and even some employers use it to make decisions. A higher score means lower interest rates, better loan terms, and more financial flexibility. A lower score means you'll pay more for everything, or get denied altogether. And here's the key, your credit score is based largely on how you handle credit cards and other revolving credit accounts. So let's break down how credit cards influence your score. The 5 factors of your credit score. Credit scores are calculated based on 5 main factors, and credit cards play a role in each one. Here's the breakdown. Payment history, 35%, credit utilization, 30%, length of credit history, 15%, new credit, 10%, credit mix, 10%. Let's go through them step by step. 1. Payment history, 35%. This is the single most important factor in your credit score, and credit cards have a direct impact. Every on-time payment you make builds a positive payment history, which boosts your score. Every late payment does the opposite, and the damage can be huge. A payment that's 30 days late can drop your score by 90 points or more, and that negative mark can stay on your credit report for up to 7 years. How to win here? Always pay at least the minimum due by the due date, but ideally, pay your statement balance in full to avoid interest and maintain a perfect history. 2. Credit utilization, 30%. Credit utilization measures how much of your available credit you're using. If you have a $10,000 total credit limit and carry a $3,000 balance, your utilization is 30%. Experts recommend keeping utilization below 30%, but the lower, the better. Single-digit utilization, like 5%, 10%, is ideal for top scores. Why it matters? High utilization signals risk to lenders because it looks like you're overextended. This can hurt your score even if you pay on time. Pro tip, if you want to improve your score quickly, pay down your balances before your statement closing date so a lower amount is reported to the credit bureaus. 3. Length of credit history, 15%. The longer your accounts have been open, the better. Credit cards can help you here because they typically stay open indefinitely if you use them occasionally. Closing old accounts can shorten your credit history and lower your score. So think twice before canceling a credit card, especially your oldest one. 4. New credit, 10%. Every time you apply for a new credit card, the issuer performs a hard inquiry, which can temporarily lower your score by a few points. Opening too many accounts in a short time can also make you look risky to lenders. Be strategic about new applications. Only apply for cards when you need them and when they align with your financial goals. 5. Credit mix, 10%. Lenders like to see that you can handle different types of credit cards, auto loans, mortgages, etc. Having at least 1 or 2 credit cards, along with other types of credit over time, helps your score. Real-life example of how this plays out. Let's say Sarah has 2 credit cards with a combined limit of $10,000. She keeps her balance around $500 and always pays on time. Her utilization is 5%, her payment history is perfect, and she's had these cards for 5 years. Her credit score? Probably in the excellent range, 750 or higher. Now imagine Mike. He maxes out his $5,000 credit limit every month and only pays the minimum. His utilization is 100%, and his balance grows because of interest. His score could drop into the low 600s, even if he never misses a payment, simply because of high utilization. Common mistakes that hurt your score: maxing out your credit cards. Even if you pay on time, maxing out your card signals financial stress and hurts your score. Missing payments. One late payment can wreck your score for years. Closing old accounts shortens your credit history and can increase utilization on remaining cards. Applying for too many cards at once. Too many hard inquiries can raise red flags for lenders. How to use credit cards to boost your score: pay on time, every time. Set up autopay for at least the minimum due. Keep balances low, aim for under 30% utilization, or better, under 10%. Request higher credit limits. More available credit lowers your utilization ratio. Keep old accounts open, use them occasionally to keep them active. Space out new applications, avoid opening multiple cards in a short period. Advanced strategies: pay before the statement date. If you want the credit bureaus to see a low balance, pay down your card before the statement closes. Use multiple cards wisely, spread out your spending across several cards to keep utilization low on each one. Monitor your credit report, check for errors and dispute inaccuracies immediately. How credit cards can help or hurt your future. Credit cards are powerful tools. When used responsibly, they can build a strong credit score, which saves you thousands on loans and opens up opportunities like better insurance rates, rental approvals, and even job offers. But when misused, they can trap you in debt, wreck your score, and make life harder. The difference comes down to habits: pay on time, keep balances low, and avoid unnecessary applications. Final thoughts: credit cards can sometimes feel overwhelming, but knowledge is your greatest ally. If you grasp the fundamentals of how payment history influences your score, you can strategically schedule your payments and avoid missed ones. Aim to pay more than the minimum whenever possible. This not only reduces your balance but also demonstrates responsible usage, which lenders favor. Remember, maintaining a low credit utilization ratio, ideally under 30%, can further boost your score and give you an edge when applying for loans or favorable credit terms. By implementing these practical strategies, you'll not only safeguard your credit score but also enhance your overall financial well-being. Knowing when and how to utilize credit cards effectively can empower your financial journey. For instance, setting up automatic payments ensures you never miss a due date, while utilizing alerts can remind you of upcoming payments or spending limits. Additionally, consider using one card for specific purchases to streamline your spending habits and track expenses better. It's essential to review your statements regularly. By doing so, you can spot unauthorized charges or billing errors, maintaining your financial health while enhancing your credit score over time. With diligence and patience, you transform your credit cards from potential burdens into tools for prosperity. Credit cards can empower your financial strategy if used wisely. In conclusion, mastering your credit card use is a journey that leads to financial empowerment, enabling you to navigate through life's financial aspects with confidence. Your credit score will reflect your diligence, paving the way for future opportunities and unlocking the doors to financial freedom. If you found this video helpful, hit that like button, subscribe to Smart Dollar Mindset, and share this with anyone who needs to understand how credit cards impact their credit score. And check out our other videos on credit, debt, and investing to take your financial knowledge to the next level.